What if I told you there are 6 key differences between investing from Europe and investing from America? And if you don't know them, you can get stuck or pay thousands in lost profits or extra taxes. Over my 18 years of investing experience, working both on Wall Street in America and running an investment company here in Europe, I've seen many European investors who follow American investment advice and make expensive mistakes. So in this video, I'll make sure that that doesn't happen to you. And let's start with a big one. You read a great book about investing, like The Little Book of Common Sense Investing by John C. Bogle, or Money, Master the Game by Tony Robbins. You watch a cool video by Ramit Sethi or Graham Stevens, and they get you excited about buying index funds, like the Vanguard 500 Index Fund, or SPY, the Spider S&P 500 ETF Trust. But when you go to your bank or brokerage and try to buy this ETF or index fund, you get denied. It turns out that because of EU regulations, we can't buy these funds which are established in America. And even if you find a loophole, like using an American brokerage which ignores these European regulations, there's a second risk that most people don't realize. You become exposed to American estate taxes. What that means is if you've got more than $60,000 in American stocks or ETFs and then you pass away, before the money gets to your children, to your family, the American government will take away a big chunk in taxes. So investing directly in American index funds and ETFs, like American YouTubers would recommend, is usually not a good idea for European investors. Now, does that mean you can't buy American stocks or invest in the S&P 500? Of course not. All you need to do is buy funds which are based in Europe, usually in Ireland or Luxembourg. And most of these funds can be found on justetf.com. This is the best database that I know for finding these ETFs which are established in Europe. And for example, if you want to invest in American stocks, you would click on equity, which is stocks, and under country, you simply select USA, United States, and you've got hundreds of funds to choose from. But you also have a lot of other options, such as global funds, European funds, Latin American funds. And in a second, I'll point out several mistakes that people make when choosing ETFs like this. But first, we need to look at another critical difference between investing from Europe and investing from America. To explain it, let's imagine that we decided to buy an ETF like this one, the most popular ETF in Europe, the iShares Core S&P 500 UCITS ETF USD. Okay? Now, if I go to the website for this fund, it's on iShares.com. I can look around, but I'm not going to see a buy button anywhere. I can't buy this fund directly from the fund provider. An ETF is an exchange-traded fund. It trades like a stock on a stock exchange. And to buy a stock or ETF, we need an intermediary, an investment app or a brokerage. If you watch American YouTubers, they will recommend brokerages like Robinhood or Webull or Charles Schwab. But in most cases, these brokerages simply don't accept investors from Europe. And even if they do, all the trading happens in dollars, which is not convenient if you make money in euros or pounds or francs. So the second insight for European investors is that you should focus on brokerages which are based in Europe. And the good news is that today you've got a lot of wonderful options. If you are experienced, then look at big popular brokerages like Interactive Brokers or Saxo Bank. If you want a really simple, easy to use app, you can look at Trade Republic or Trading 212. There's really a lot to choose from. But you also have to keep in mind that in some European countries, it's important to use a local brokerage because that makes taxes easier. For example, in Germany and Austria, a lot of people like to use Trade Republic or Flatex or other local brokerages which handle your taxes. Okay, but now let's move on to the next key difference between investing from Europe and America. When looking for a brokerage, we imagined buying an S&P 500 ETF. And this is, as we saw, the most popular choice among European investors. But what if I told you that this could be a mistake? Now, you will find a lot of American books and videos that tell you, oh, just buy the S&P 500. It's diversified enough. You've got 500 different companies in different regions. They do business all over the world. It's a wonderful portfolio. And that is reasonably true if you live in America, even though even most American experts would recommend adding a bit of international diversification. But for us living in Europe, buying the S&P 500 means that 100% of your savings are exposed to America. In the age of Donald Trump, that means that 100% of your savings are exposed to the decisions of one very stable genius. And you kind of have to decide if that's what you really want to do. If you don't, if you want to diversify more broadly, you have many options. You can go to justetf.com. You can look at different regions. So, for example, you've got world funds. So these are global funds that invest in many different countries. Or I can look here and look up European funds. So we've got 377 of those. We can look at Latin American funds, emerging market funds, and you can combine them. Now, usually it's a good idea to try and keep your portfolio relatively simple. So instead of having 10 different funds for different countries or regions, look for solutions where you can build a good portfolio with 2 or 3 big regional funds. Now, I'm not saying don't invest in the US. A big chunk of my own portfolio is invested in US stocks. I see a lot of potential there with the AI revolution. All I'm saying is that for European investors, it can make a lot of sense to diversify globally. But this brings us to the next challenge for European investors. Let's say you do decide to invest globally. A typical global ETF will invest around 60 to 70% of your money in the American market, a bunch in Asia and other countries, and only around 10% in the Eurozone. So this means that as much as 90% of your money is invested in other currencies instead of the euro. Or if you live in the UK, as much as 96% of your money is invested in other currencies than the pound. So this means you are exposed to currency risk. Imagine, for example, that the S&P 500 stays flat. Stocks go neither up or down, but the US dollar gets weaker by 10%. Well, translating to euros or pounds, your portfolio goes down by 10%, even though stock prices haven't really fallen. This is a real risk and it can harm European investors. Now, there is some good news here. Most experts consider that for really long-term investing in stocks, currency risk is not such a major factor. For various reasons that I've covered in a different video, it can be completely fine to leave things as is and not worry about the currency exposure. But if it is a concern, there are solutions such as currency hedged ETFs. For example, here on justetf.com, you can scroll down to currency hedge and you can choose funds which are hedged to euros or pounds. And this removes the currency risk between the foreign currencies and your local currency. Just keep in mind that these currency hedged funds, they have some additional costs and risks, so you need to educate yourself. But the point remains, European investors should be aware of currency risk. All right, next up, we actually have an opportunity. This is a rare area where we, European investors, actually have an advantage over Americans. But if you only listen to American videos or read American books, you will never find this out. Okay, so in America, when you buy an ETF, and the ETF gets some dividends from the companies that it buys, those dividends get paid out to you. Because of the way American tax laws work, this is pretty much the only choice. But here in Europe, we also have a second choice. We have so-called accumulating ETFs. And what happens with an accumulating ETF is that when the ETF gets dividends, it doesn't pay them out to you. It just uses this money to buy more stocks. Now, the beautiful part is that in most European countries, if you don't get dividends in your account, you don't have to pay taxes on them. So this means you can delay paying taxes for many years while the money stays inside the fund and keeps growing. And this is much, much better for your final wealth. So the fifth key insight is that in Europe, you should really consider using accumulating ETFs to optimize your taxes. Unfortunately, there are a few countries where this doesn't work, such as Austria and Switzerland and the UK. But in most European countries, accumulating ETFs get you better results. And by the way, it's very easy to find accumulating funds on justetf.com. You just go down here to use of profit and you can choose between accumulating, so that's funds that reinvest dividends, and distributing, which is funds that pay dividends out. And you can see that there's actually a lot more accumulating funds available to European investors. That's because they are more popular, because in most countries, they get you better results. Okay, and now we get to a really big, critical point. Have you noticed how every American investing video talks about things like 401ks and IRAs and 529 plans and stuff like that? No, I mean, those are not exotic diseases or the names of indie pop bands. These are American tax structures. And they are really important if you live in Connecticut and want to not overpay your taxes. They influence the kind of ETFs and strategies that Americans will recommend. But the problem is that for those of us living in Berlin or Madrid or somewhere else in Europe, all this is totally irrelevant. Here in Europe, we've got 30 plus different tax systems. And the best investments in Spain can be quite different from the best investments if you live in Portugal or the UK. Now, I can't cover all the tax details of different European countries in this one video. I'm going to share a resource for looking at this in a second. But one important thing that I will mention is tax-advantaged accounts. Okay, so in America, you've got IRAs and Roth IRAs and 401ks, which allow you to invest with tax benefits, basically paying less tax than usual. Many European countries also have similar accounts, and if your country does, this can be a huge advantage. Now, I've actually done a lot of research into these tax-advantaged accounts across Europe for the members of my training program, the Index Masterclass. Just check out this table that I put on the screen with account names in different European countries. If you see your country listed, look into the tax-advantaged accounts you can use. So my final insight is this. Local European tax knowledge can make a huge difference to your wealth over time. This is something that you can never get by watching American YouTubers or reading American books. And that's actually exactly why I built a European tax database for the members of the Index Masterclass, my step-by-step training program for European investors. Our program members don't just master ETF and index investing, they discover how to do it in a way that's customized for your local European country, whether that's Germany or Spain or Poland or Slovakia. So if that sounds interesting, follow the link in the description to find out more.